part is just application of this simple model into more realistic accounting. Before we go this one, I usually ask my student to create a simple household accounting model. Since we have no time here, I just give you a simple idea of how you create your own household accounting model. Then I leave this PowerPoint slide with Professor Minato, and you can just take a look later. Okay, where is okay, here. So the simple household accounting book is very, very simply structured. Actually, we have only one stock of cash. The simplest accounting model of cash flow. But to our surprise, our government are using this same simple accounting method, not the double entry accounting method. Our government in Japan. Okay, that's very, in a sense, the best surprise. They are not using a double booking accounting book. Only recently they started using to figure out how many or how much national debt they are just having. So it's still at that level. So that is why I used this double booking accounting modeling to analyze the debt crisis of all government macroeconomies. Okay. So this one, if you are interested, you can create this model by yourself. It takes only 10 or 15 minutes, but still you can learn the basic principle of accounting. And the interesting is once you create this simple model, you can use this one with your, say, mother or to figure out how much the money we have to save. We have to save to make some big purchase later. So this kind of simple the scenario analysis can be easily done. So we usually create one cash, then cash inflow and cash outflow. That's very simple. And whenever you take this net cash flow as a difference between cash inflow and cash outflow, you have a concept of net cash flow. Okay. So here you just create many items of the source of your income. If you are working, you just create wages, and if you have wages and bonuses and windfall incomes, and if you own your the property or apartment, you do get rental income, and if you have stocks, you can bring dividend and other benefit grant. Those becomes your source of incomes. Then all incomes go into your cash inflows. Meanwhile, you can itemize any expenditure items, including from food, clothes, housing rent. And utility phones and all other items. So this is the first step of creating your own household account. Then by using the expensive simulation technique, you can easily simulate how much cash you are going to deposit by changing your parameters. So it's an easy thing. Okay, so this is the first part. Then now you bring financial systems. That means now you have a feedback. You calculate the interest rate. And the interest rate we put into the cash inflow again. So in this way, you keep calculating all the composite interest. So in this way, now this becomes a system because now finally we have a feedback loop from stocks. This is a simple stock. But interesting question is why those who have cash or money in the bank do get interest and become richer and richer. So nobody think more serious about our financial system, but to pay interest depends on the system we created. So that is now causing a lot of inequality issues recently in the United States, in Japan. There are a lot of poor or the lower paid worker people. Meanwhile, less and less rich people are accumulating more and more wealth. So that can be easy just modeled by this simple financial systems. It's because of the interest payment. Okay. So in this way, now your simple accounting model can be expanded to financial systems. No one can answer well why then we have to pay interest. Okay. That's a very serious question for economics. Okay. Then the next question, if you are running out of cash, that means your income is not enough to cover all your expenditures. Now, what thing you have to do next is to make loans. From here, now you have to bring the double booking accounting framework into this simple model. So when you make loans, you are creating a liability side. So I really recommend you to create a debt stock. And whenever you borrow money, this is an increase in debt. At the same time, this borrowing amount will enter into your cash. So this is a kind of jumping point of your simple single entry accounting into a double booking account. And as long as I understand, all household accounting book available in the bookstore is based on these simple ones. I have never seen any accounting book which are just structured according to the double booking accounting system. So I kept encouraging my students, write a simple household accounting book, simple one using system dynamics, so that can be very popular. And that's good educational process. So, and it's good business. You write a simple model, and I asked my students to create this one. So it's become very successful, but it never printed out as a book. So it's now whenever they ask, create the loans in a model. So without this simple principle, they make loans here and here. So that's why their model become very, very complicated in the end. So I like it to just bring the debt as a liabilities. And whenever you borrow money, you inflows, that all monies come from this side. Then you borrow money, your debt increase. At the same time, your asset of cash increase by the same amount. By the way, this is the cash flow from finance, anyhow. Okay. So then you make loan and you purchase automobile or houses, or you make a trip to foreign country. So this is the same as a corporate project. Whenever they do start any project, they have to borrow money, they have to fund, they have to raise fund. So whenever they raise fund, then their money, if they borrow money from banks, exactly have the same structure. So we borrow money and use that money to make investment for projects. So in this case, we buy automobile. So at the same time, now you have to figure out how much money you have to pay as a principal and how much interest you have to pay. So from this point on, without using system dynamics, it's almost becoming impossible. You cannot create this model by using Excel. You can ask the expert Excel to create this model. Sometimes they may successfully do that, but it may take some time. So in this one, you start just calculating interest. So whenever you pay principal, you subtract from debt. At the same time, you subtract from cash. So in this way, we are just keeping in balance. At the same time, you can calculate interest out of this remaining debt. Then whenever you pay interest, you also subtract interest payment from cash. Okay. So this is the same as any project modeling, the same structure. Then finally, once you have this asset side and liability side, now you have to figure out whether this project is profitable or not. So to figure out this one, we have to bring the equity concept. Okay. So once we have equity concept, that means all now income from cash inflow have to be balanced by the increased equity. So that means whenever you calculate cash inflow from wages and other source of income, have to increase your personal equity. So in this way, now we have complete double booking structure. Income inflow, increase retained earnings. At the same time, whenever you pay interest, this time interest will be paid out of your retained earnings. So you calculate interest, but the interest have to be paid out of your retained earnings. The same non-operational cost. So that's why whenever without this one, you calculate interest and you pay interest from cash, but you never show where interest rate have to be paid out. It have to be paid out of this retained earning. Okay. So in this way, now we have a complete structure of asset, liability, and equities. Okay. Then once you have this the model, now you have to figure out how many years you can use your automobile, or how many years you can maintain your apartment. So in this case, you have to bring the concept of depreciation. So whenever you subtract the depreciation, your retained earnings also will be decreasing by the same amount. So in this way, you subtract from both sides. Right. And once you come up this one, now you have to show this retained earnings more in detail. Retained earnings is the stock of all income statement, as we discussed earlier. So that means this income, inflows, and outflow have to be summarized in terms of this retained equity. So at that time, now you create new pages, and you only bring retained earnings. So here, all inflows into cash will be summarized here. I'm sorry, this is not cash flow, this is retained earnings. So all income source come from this one. This is the same as sales. For household accounting, there will be no sales, so you have to use income as if it is a sales of the product. So all source of incomes are just repeated here. Then all expenditure, this is the cost of goods, and expenditure as same as this expenditure. And depreciation is another the non-operational cost, and interest payment. So in this way, the household booking can be easily just expanded into corporate financial statement. So typically, household bookkeeping may use this one or this one, either one. So I was always wondering if all people have this idea of the double booking entry for household from the elementary kids, then their sense of accounting become very, very developed and sophisticated, so that then they automatically try to figure out what's the equity we have to maintain. So this is a good educational system. So that is why J. Forrester, Professor J. Forrester, who is the founder of the system dynamics, tried to use system dynamics in K through 12 education. That means from kindergarten to high school. So a lot of the American teachers just supported his idea, and they started using system dynamics and system thinking in their educations. So this is a project we like to promote in Japan as well. So we thought that what's the best example to promote system dynamics from the elementary school days. The best way is to introduce this kind of accounting book. So our NPO is trying to just promote this one, not successfully until recent, but we try to just promote this one. So if you are back in your country and interested in system dynamics, I like to use this kind of ideas to develop a sense of accounting. As a matter of fact, this is not to offend Americans, but from my the study experience in the United States, Americans have carry a lot of the credit cards, but they never know how much equity they have. They can't manage their own household. So it's a terrible thing. We Japanese, even though we don't use this accounting book, still we try to maintain balance, right? But Americans never pay attention. They keep paying, and whenever they can't pay, they apply another credit card, and they pay another credit card. They pay. So that's why we really need this kind of
blacklisted if you don't pay.
system dynamic concept from the beginning.
Yeah, if you got a credit card from a bank, then you won't get any credit card from any other bank.
So that's why even while you are creating your business model, always I like to keep this kind of balancing model in your mind all the time. Then in this simple basic model, you can easily create all graphs and tables, and you have all the slider parameter controls. In this way, you can easily figure out if we make, say 300,000 yen and as a loan, and we pay in 10 years, what kind of car we can buy or something like that. So we can run simulation and easily figure out. Sometimes this is anyhow first modeling exercise, serious modeling exercise to my students. Then I always ask them to create a bankruptcy simulation model. What happens if their income suddenly reduced or they lost jobs? How can they survive? Just run the simulation model of your bankruptcy. So this is a good simulation model to figure out what to be the important factors to in your account in solvable situations. Okay. So anyhow, this is a simple application. So I give this slide to you. If you are interested, you can create your own household the models using your current situations. Most students only have the scholarship or the parent support or the part-time jobs. So then we can figure out in 2 years, 3 years, what will be our situation. Okay. So this is a simple application. Once you go through this process, now you are familiar with the accounting modeling. Because you have studied principle, you have a very simple application. Now you like to learn how to really create model by using more realistic examples. So from here, I'm going to show you. Actually, I have no plan to go in detail, but I'm going to show you a basic framework of the financial statement. This is a very well sold book in the United States, as long as I see, because this have a lot of editions. And the reason why this book is very popular is always we have the same 3 statements on the one page and all transactions on the other page. And whenever transactions change, all framework of the corporate statements stay the same, but only numbers are changing. So that is why this book is very, very useful to understand. Actually, to tell my own story, I purchased about 10 books of English and some Japanese books, start reading to understand the accounting. So I have a lot of confusions. And finally, I hit upon that book. That book gives a very intuitive way to understand how three different accounting statements are related to each other, because already we have the same framework. So if you are really eager to study accounting in English for Japanese students, I really recommend that book. And okay. So, and the good thing of that book is that book always have a stories of startup companies. In this case, this is a startup company transactions. You have just incorporated in Delaware. By the way, Delaware is, is a famous, well-known state because it's so easy to set up new business. Okay, so many corporations have a headquarters in Delaware. Okay, so this company also incorporated in Delaware and invested 50,000 of your own money into the company. The company name is called Appleseed. That's just a soft drink company. When you formed the company, you bought 50,000 shares of founder's stock at $1 per share for a total investment of $50,000. So the person wants to start up this Appleseed company, and he issued shares, and he becomes the owner of the investor or the owner of the company. So he issued 50,000 shares and $1. That means $50,000. That means he paid $50,000 to start up with new business. Okay, that's the start point. So then the book tried to explain step by step how much money we have to raise more and what kind of product we have to buy and how we can put those data into the accounting book. So it's really interesting. If once you go through, you really understand all cases of transactions. And what I did, I tried to model all transactions into this simple system dance framework. So for instance, transaction-wise like this, a group of investors is willing to exchange their $1.5 million in cash for a stock certificate representing 150,000 common shares of Appleseed enterprise. That means someone are eager to support $1.5 million. So this person just started to sell 150 common shares, one share per $10, $10 per one share. Okay. That's after this sells to the investor group, there will be 200,000 shares outstanding. They will own 75% of Appleseed and you will own the rest. So you remember the 50,000 is the initial stock, so you become the investor of your own company. So at that time, you only paid $1 for stock, but now you are selling one stock for $10 as outside investor. So in this way, this business is going to start, going to raise about $200,000. So this is anyhow the way you raise funds to start any business. Okay. The question is how you can just put this transaction into your accounting. Okay. The second transaction is book all payroll associated company expenses totaling $6,230, including salary, employees' contribution to FYC. FYC is the Federal Insurance Contribution Act. So the same as insurance, social security or insurance program in Japan. So this was created after the Great Depression to secure the more workers' situation. So they are forced to pay some amount for security. And various insurance expenses. Issue yourself a payroll check of $3,370. Your $5,000 monthly sales minus this amount, $1,250 in federal and state withholding tax and $380 for your own contribution. So from here, it's very complicated. Right? So the question, how we can model these things? Okay. By the way, it's interesting. See, whenever you start new business, you borrow money or you raise fund, right? Then the good thing is you pay your salary out of the money you raise. So this is a thing which we are lucky in Japan. In the Silicon Valley, I made a visit last year. I took my student to Google and Apple and other Silicon Valley startup companies. So, and I met a couple of group startup companies doing business, IT startup businesses in San Francisco. Most of them are just former employee of Google. And they told me, no one wants to stay at Google forever. They wanted to work for Google for some time. Then whenever chance that appears, they just try to spin off Google and start up their own company. And they told me that the IT group are developing very interesting the voice recognition softwares. And they told me they have already more than 1 million users, but their stock is not still put on the market. So they made a couple $1 million, more than $1 million. Lot of seed capital is available. So to be interesting, whenever they have investment money from so-called angels, so they can pay their salary out of their money. That means once they have $1 million of seed fund, then they start paying to themselves. So the salary would be better than the salaries of working people. So that is why once we have a big angels investors, then at least they can use that fund as their own salary for 5 years. And the good thing, even though their business failed, no one forced them to pay back the original capital because that's a kind of risky investment. So the person I met getting $200,000 as a salary 1 year. So their job is secure for 5 years at least. Then 5 years, they can start employing young graduates who are skillful with IT. Then they come with new ideas. So this sentence just remind me of that they pay salaries out of this fundraising. Okay. So in this way, transaction goes on. So as a summary, where is in the textbook, okay, you have just copy of this one. So this is just table of the transactions. In this case, there are more than about 30 transactions. I just assumed one transaction would be done in a week. So this is a summary of all transactions. Actually, some transactions are done in a day, but I just, for the simplicity, I just treated one transaction is done in a week. So that means this transactions covers within 30 weeks, something like that. Okay. And in my textbook, let's go to the, okay. Okay, textbook. This is a transaction which I just described. And this is how I summarize. Whenever we have transactions, the T column means this transactions, just new issue of shares, 150,000 common shares. So this is the way I just describe transactions in the textbook. So whenever we create transactions, then that's affect two stocks. In this case, when we issue new stocks, that means capital stock is affected, that increase. At the same time, cash stock is increased. So this is how we summarize all transactions. One transaction causes two stocks to change. So this transaction causes capital stock and cash to increase simultaneously. And the second transactions, transaction general and administrative costs. This is the transaction which I have already read in the slide. So this transaction, general and administrative payment, changes accrued expenses and retained earnings to increase accrued expenses and retained earnings. That means we pay out of retained earnings, but we just keep it as a liability. So accrued expenses increase. So this is a movement within the retained earnings and liabilities. At the same time, when the payment due comes, then we pay accrued payment out of the cash. So that means accrued expenses now reduce and cash will reduce. So we subtract the accrued expense out of retained earnings and put into liabilities. Then when we have to pay, accrued expenses will reduce and we pay out of cash. So this is how we try to summarize in terms of this the language. So it's still complicated. Still complicated. Okay. So in this way, all transactions are explained by this formula, transaction 3, 4. So we don't have time to cover. So, but if you are interested in, you just go through all transactions as a team. Then you really come up with a very good idea of how to create all transactions into your system dynamics models. Okay. All right. Now, let's go to the model. So this is the idea, and now I have created this model, and it's available, and accounting Benson package model. Now you have this model. I think Professor sent you this model. You don't get model?
It's in the Keio.
If you don't, I want you to just install right now and open up. You have model? Okay. And just let me know if you don't have. So if you have model, just try to open it. Open it and just I'll show just a best framework. Okay. First, this is the top page of this pencil. Please open this model.
Okay, I'm not able to.
We need to download a new software, Dance Leader. Not a Dance Leader.
So when you create a model, it's sometimes better to create this kind of overview or summary or a navigation page. So I create this navigation page like this. This is the navigation button. Whenever you press this one, you can jump into this page and come back to overview. And at the same time, if you just press any button, you jump into that page, and you come back, you list of transactions. So even PLE has this, yeah, free version has no, this function. Yeah, that's a kind of limitation. But I encourage you to use PLE because PLE has a very, very powerful functionality, and many students at MIT and other UNESCO are using PLE version. Okay, that's right. So this is only available for the create multiple pages by period. You show the all cash flow statement, income statement, and also balance sheet and data. Those kind of structure can be easily summarized. Then you jump into this one. Okay. So this is the first page. Then the next balance sheet. So once you created balance sheet, by the way, balance bookkeeping. This is a diagram which I have already explained, but just for the memory of the user, I just copied the same structure of the asset and liability. So already come up to this structure, maybe credit, and so it's a good way to always remember the basic structure of the accounting. Okay. Now, and balance sheet. Once you create balance sheet, now you bring all accounting items, this asset and liability, and liability consists of current liability and long term. The difference between current and long term is this liability which we have to pay within a year, this liability which need not be paid within a year. Then shareholder equity consists of capital stock. This is the real shareholders equity part and retained earning part. Okay. So once we have this kind of accounting asset and liability items, you can just summarize those into more larger concept. In this case, cash, accounting receivable, investment, prepaid expenses constitute all current asset. If you want to see the definition, just click current asset and click this one. So current asset is equal to cash plus all equations available. And if you want to see what is cash, you click this one, cash. Then you click documentation again. So you see the definition or this one. So in this way, you can just delve into the details of equation. The reason why we need this summary is that once you conceptualize all assets into more bigger groups, then later you can use this concept to do any ratio analysis. Ratio analysis is the most essential part of the business. All managers have to do this ratio analysis, whether their company is making profit or what's the weak point. Those kind of things have to be always calculated by using ratio analysis. But basis of ratio analysis is depend on all the balance sheet items. So you now create current asset, and in this case, other asset, and the book value. And whenever you add those three, we have a concept of all asset. So the same way, liabilities are just grouped into current liability and long-term liabilities. Then we have the equities. So in this way, once you have this concept, this is very useful to now do the ratio, which I'll show you later a little bit more. Okay. So it's a good summary of balance sheet. Okay. Now bookkeeping. This is just diagram. And from this income, let's go to the first of all, balance sheet. Okay. Oh, by the way, you know how to enlarge or shrink the pages, right? Just Control Shift and drag with right hand button. So you see in this diagram now, this is the step-by-step modeling. Now you see this is the liability side, this is asset side. All monies which come from here have to go through, this is a cash stock. This is obvious, right? That means this structure cannot be understood whenever we only look at the balance sheet. Once again here, cash always is one item of the whole balance sheet. Okay. That means people who study account don't understand how cash stock is influential. Even though they know that this is the basis of cash flow, but they don't understand why cash flow is important, because this is only one item, right? Just small item. But if you try to model all transactions, suddenly this cash item, you see, become big, elongated stock. That's all transactions have to go through this cash. Okay. That is why cash statement is the most essential statement in financial report. And now from here, the inflow and outflow are just classified into operating activities. This is the cash flow we obtain from operations. That means from regular corporate activities. Then we make that cash to make investment activity. Investment activity is always one-way activity. We spend cash to buy product, always negative. And whenever we are running out of money, then we raise fund, this financial activities. So in this way, I classify 3 different cash flows. Now you can easily understand why it's better to have operating activities of cash flow, investment activities, and financial activities. Okay. So, but without concept, you just try to connect in a chaotic way. So that is not a good way to do it. Whenever you create model, always try to rearrange the cash flow according to operational cash flow or investment or the financial. Okay, it's very important because this is the way the manager understand. Okay. Now, okay, this is a basic structure. Then, how we can put data here? There are several ways to bring data into these models. Actually, PLE version has a lot of limitations to bring data. They can't bring data from Excel directly. So that is why I used table functions, because that can be available for the PLEs. And I have another version. Another version have data input from Excel table directly. But I found those readers who do not have Excel cannot run model. So I just original model has only data available from Excel directly. So whenever we run simulations, this BenSim start up Excel directly simultaneously and bring data from Excel. But I thought that's not a good way to distribute my model. So I just have rewritten this model so that then this becomes self-contained model, so that we don't need any Excel and other application software. So here, data, just go to, okay, this. This one. So, for instance, if you, this is a model reader, so you can't open the editor, but if you click this one and you click document, now you see this is accounting receivable paid table. This is a table function, and this is a argument of tables, and so it looks like this. So this is the argument. This argument of table function is on time. That means whenever this model runs from time 1 through time 31, this is data we use. So in this case, wages are only paid in the week of 23rd, like that. So you can only get all data. Okay. You are familiar with the table function already, right? Not yet?
Product.
Okay. So you can it's very easy to create table function. So the good reason why for basic use table function is whenever we do this synthesis, whenever we do this synthesis, okay, we have this table function as a just the variable which we can just change. For instance, whenever under the synthesis simulation, if we click this one, we can easily get to this one. Then we can easily change all data. And whenever we change this data this way and this one, then say purchase will be also here. So in this way, you done this basic model to do more realistic case study of all transactions. So whenever you change this data, then basically instantaneously run the simulation and store the result under this current file. So that's a good thing. So in this way, now if after you become familiar with this model, you try to create your own story. What will happen if then sales are increased by this amount or something? Okay. Then you just change this one and you see the result. Okay. If we have that, we come back this one. So in this way. So this is how we create a table. And once we have table, and once we run this one, simulation, now you get the already result. Okay. All right. So in this way, I put all data under this table functions. So you can check any data, and even this one graphically, you just get this one. This one, you get graphical result. All right. So this model has a lot of data like this. But I just classify this data according to the main stocks which may be affected by this transaction. Those transactions only affect cash as a primary stocks to be changed. This cash receipt, cash disbursement, and inventories, all things. So in this way, if you classify all transactions under different stocks, it's easier to identify later. Okay. So in this way, I put all data. Now we go to the transaction. The textbook. PowerPoint. Yeah, for instance, this one. These are fast transactions. That means we now raise fund by selling investors to buy our stocks. So if we successfully sold our shares to investors, the question is how we can put this one into model. So in the model, in the model, I put the numbers. So that means number one means this is the transactions of the first transaction. So if you want to see how we can bring that transaction into the model, you can search for the number. So that means one is this new issue of share. This is the first transactions. So click here. Okay, and this number, that's only at the first week or first month, then we we sold 150,000 shares. Okay. Then par value is just $10. That means capital stock issued should be $1.5 million. So this is how we are going to bring the all initial fundraising. So whenever we sell this number of stock and if we multiply the par value, then we have the amount of fund we raise. It increases capital stock. Okay. At the same time, this capital stock will increase sales of capital stock. So, okay. So that means this transaction is balanced by the increase in capital asset. So you follow this one step by step. I usually ask the student to just follow the transaction example and check how we can bring that one into this model. So after you complete 35 transactions, I think you are most expert of the modeling, accounting. Okay. So I really like you to work out as homework with the team. So you go through all 35 transactions. The textbook already is available. And you just start with, for instance, say, the next question, transaction 2. This is a little more complicated one. How do you bring this transaction into Benson model? So you discuss this one for a while. Then you go into my model and check this number 2. Number 2 appears maybe income statement. Number 2. Number 2, operating expenses. So we just subtract as a cost, but we don't pay this deduction from the cost. We put it into liability for a while. That means number 2 will be subtracted. That means whenever we subtract, our revenue will reduce. At the same time, our liability increase for a while. Then this will be paid out if this accrued expenses is part of the this balance sheet. Okay, where is that? Yeah. Okay, this one, balance sheet. Okay, accrued investment. Whenever it's paid out, all payment will be done out of this cash. Okay. Now you see how you follow this accounting. So just try to follow all the accrued expenses will have to be eventually paid out of cash. That means all this input will be subtracted from cash disbursement. Actually, if we click this one, the all account payable paid, account expenses paid, interest expenses, and plus wages. Okay. And this account payable is a gain is obtained from this table function. Accrued expenses paid will be a gain from this data. Okay. All right. This is a kind of painful, but I really like you to just go through with your friend at least once. So that means only one book is just summarized into this simple system dash model. Okay. Now that's okay. Now in this way you try to follow all transactions. Okay. So far, any questions so far? It's simple. It's beautiful. That's what once we actually. I showed this model to the former president of the Kyocera. Kyocera is a Kyoto-based company, and the former president's name is actually Kyocera's chairman supervised the Japan Airlines, right? Bankrupt management. So Kyocera became very famous for that new manager. What's the name of manager? Kyocera. Inamori, okay, Inamori. So after Inamori, I think the there was a president. He took the president position, and sales revenue doubled from 1 trillion to 3 trillion something. So he's a very, very talented Kyocera manager. And he looked at my actually not this one. I showed him. If I have time, I'll show you the Toyota's. I brought all Toyota's accounting into this framework, and I showed whenever we press one button, we can easily figure out what's the revenue, what's the investment of Toyota's. And he said, oh, if I have this software available with me when I was a president of the Kyocera, I could have used then, so that I saved time, because whenever he needed more data, he made a phone call to the data office to get data. But once we have this software, he need not call his data office. Just click this one and checks, and he can already check all balance sheet behaviors of the company. So that is why I'm still thinking this is the best way to understand all corporate activities without the help of other experts. Right? So if you are interested, you can bring your own model in this way. If I have to, I'll show you Toyota's case. So in this way, you can pick up any data you like. Okay. Now, how we can use this model? Whenever we have all data, you just run this one, once again, simulation, and all now summary diagram is available. But simple diagram can be easily created by software itself. For instance, if we want to really to see the this cache, you just click this one and create this one. At the same time, if you want to couple diagrams together, I think you know this function. Just you press cache, account receivable, book value, and whatever. Oh, I'm sorry, this one, book value. Then just press this one. You see them together. You know this function already. And at the same time, if you just create this one, you get all the data together. So this is a powerful feature of Vensim. I think this is available for PLE. So you need not create custom graphs. Of course, custom graphs is better, but if you want to really check your result quickly, you just select whatever the variable you want. Just click this one, 4, 5. Then just diagram all together, and again all together. So it's so versatile software and very powerful. Of course, this is not a simulation, but this is just a record of all transactions. That means we can't do anything because this is a past data. But still, we can check how our company behaved in the past. Okay. All right. But this is not so interesting way to utilize this accounting. So the best way is to analyze a kind of relation between some balance sheet items. And from here, we go to the ratio analysis. How many are familiar with ratio analysis? Have you ever heard of ratio analysis? Keio 분析. Lot of the consultants are just making money by showing ratio analysis. So they are not creative, but just they got data and just manipulate data and get some analysis. Then they sell it as a consultant. Okay. So this software, this accounting tool, just don't need such consultant anymore. We can do by ourselves. Okay. So here, ratio analysis. Actually, there are a lot of concept of ratio analysis, but in my Toyota model, I brought almost all available ratio analysis. I just checked a couple books, and I brought all ratio analysis. It's a complete ratio analysis models. So if you like, you can do the same thing for your companies. So ratio analysis is summarized at the end of that book, because the one purpose of this the accounting is to attain the analysis of the performance of the company. Right? So to do the analysis, the best way is to compare the rates. All but data comes from the balance sheet. It's already there, but it's useless unless you just manipulate and show it more in a strategic way. So the ratio analysis consists of the liquidity ratio and asset management ratio and profitability ratio and leverage ratios. Actually, those four are the most important conceptual the definition of the ratio analysis. And now you see, I put the numerator and denominators as a stock and with different colors. So all blue color is just asset. This orange color is the liability, and yellow is the equity. So this is very visual. So first analysis is liquidity ratio. Liquidity ratio is whether our company has enough money to operate. So to figure out this one, first thing we have to do is, you see, this is a current asset. This is asset we are able to utilize within a year. That means whenever we have a current asset consists of cash. Cash, we can use cash anytime. Account receivable, if we force the buyer to pay, so we can get cash very easily. And inventory, we can sell inventory to raise fund, and prepaid expenses, so we can easily cash. So those are the assets we can easily liquidate for payment. That means this amount we can always repay. And this is the current liability. This is the amount we have to pay within a year. That's the account payable, accrued expenses, and tax payable. Okay. The question is, if we have, say, $100 asset and liability is 200, so what does this mean? Liability is twice as big as current asset. Within a year, we have to pay 200, but we have only make 100 available within a year. That means this have to go bankrupt. So that means this ratio have to be always above 1. Right? So this is the first thing which consultant usually check, whether your liquidity ratio is really safe or in just below the water. So, and this is the current ratio. But current ratio is not so used. Sometimes we need more quick, because we have to pay, otherwise then we have to go bankrupt. So in that case, out of current asset, we only calculate cash and account receivable. That's the only cash we are just we make ready for the payment. So for instance, a lot of banks are now suffering from cash payment. So they have a lot of poisoned securities which they can sell. In the United States, Fed is going to purchase just one. It's called quantitative easing. But now new Fed chairman announced that Fed is now reducing the QE. That means suddenly banks' bad securities cannot be purchased by Fed. So there are nowhere to sell. So a lot of now financial banks are now in trouble still in the United States, Europe. So that means now their cash and, say, account receivable is less than current liability. So it's a serious problem. So these are two items which we have to check. if we click this one, we do check. This is not a good example, but in the beginning, it's safe, but eventually, it's getting lower. Okay. Let's click one again. Okay. But still above 1. So this company can be solvable. Okay. So this is how you utilize this accounting. Right? In the same way, quick one. So just say current and quick ratio together. Not this one. Okay. All right. So it's hard to tell. Now you know the Benson real nice way to show to enlarge. Not this one. Okay. So show more control. I just made it. Just we have to reset the time again. Okay, reset time. Okay, just reset. The 31 again. That should not reset. Okay. Okay. Then show the graph. It's hard to tell. But Bench have a good tools to enlarge. Just this one. Okay, again, tool. All right. You know this, right? So you can enlarge instantaneously. Okay. So these are very good functions. Then you see now, and if you are not familiar, then you check this one. All are still above 1. So this business could be safe. Could be safe. So in this way, and if you want this one, you just click one by one. You reorder. You see, you reorder. Good functions. Most people don't know. You try this one. So you many windows and you show one. Okay, I'm not sorry. This is good when we create chaos. Chaos really need a sensitive analysis of very small region. So for this one, even though in the beginning this doesn't make a lot of difference from big one, current not this one. Yeah, this one. Yeah, okay. Yeah, this one doesn't make sense, but when you enlarge this one. So that means this business is still safe. Right. So if you're interested, you can just bring this kind of idea. After you create balance sheet, you try to do ratio analysis. Okay. Any question about ratio analysis? And then you just erase all window, close all output. All right. The most interesting ratio analysis profitability ratio. This is the most popular concept. Many people, even though the beginners, investors discuss about this concept. ROA, ROE, you know, familiar with return on asset, return on equities. What's the difference between return on asset, return on equities? Always say the ROE of this one is this one compared to this one in other companies. So this is a good buy of this stock. This kind of conversation really presuppose profitability analysis. So most popular one is return on asset, ROA. So denominator comes, the asset become a denominator, and numerator is a net income. For the ROE, we use the same net income. Net income is a real profit for one accounting period, say 1 quarter or 1 year. And this is the amount of asset. That means, you see, all balance sheet, we use all asset to create profit. That means out of all asset, how much money we create within a quarter, within a year. So that ratio becomes a return on asset. But asset is not so precise. For the investor point of view, the money we invested to your company how much profit is created out of the money we invested to your company. So in that case, we need instead of asset, we need a shareholder equities. Okay. This is the amount of money. Say if we for $1 create say 50 cents, something like that. So the other side is just corporate price equity price earning price. There are some other ratios. Okay, let's just forget earning price ratio. Price earning ratio. Okay, to make $1, how much money we have to put. That's reverse of this ROE. Anyhow, if you want to see the definition, return on asset definition is just net income divided by asset. Then the net income is this amount and asset is this amount. So you can easily understand the concept. The shareholder equity can be also from definition of this one. Okay, net income divided by shareholder equities, and shareholder equity is consists of capital stock and retained earnings. Okay, right. So let's see, and ROA and ROE. Since this is a very irregular transaction, because each transaction is just assumed to be done in a week, so it's irregular. But still, it's in the beginning, for a while, we have loss of income, but eventually we attain. Okay. This ROE. The other interesting concept is leverage. Those turnover ratio is also very important. For instance, inventory turnover means this is the cost of goods sold. This amount of cost we recover, if we remember cost of goods sold out of retained earnings. This is inventories. Inventory is the total amount of inventory. So how inventory is going to cover the cost of goods sold. So this becomes the inventory turnovers. In this case, inventory turnover ratio is 0 points, very slow. Okay, because inventory is bigger than the recovery of cost. But how about the asset turnover ratio? Asset turnover ratio is out of this asset we create this sales. So this asset is just creating this sales. So how much asset will be covered by sales? This concept gives us asset turn ratios. So here, only we begin to sell. So we only have this one, close to 1. That means we are making sales, which is big enough to cover all assets. Around 1 is a very healthy, I think, ratio. Okay. So in this way, we can figure out whether this company's sales is attaining a turning over in a healthy way, or it's very slow. So this is a way to compare. Actually, if you calculate only one company, you don't get so much intuitive understanding. But if you compare the company of the same industries, you can easily tell the difference. Okay. So the last one is the leverage ratios. Leverage is familiar. Leverage is just, as you see, this leverage, right? Leverage. So leverage means, in this case, I have $1 million, and I want to use this $1 million as a leverage. Then I do get, say, $100 million. That means I use only $1 million out of my pockets, then I do get $100 million. That means my leverage is 100 times. That means I'm using someone else's monies to make money of our business. So that's the leverage. So under the stock price booms, a lot of investment companies did a very big leverage, but sometimes more than 100. That means they just borrow a lot of money to buy the poisoned securities. But once they make a small portion of profit from security investment, then the leverage point is very big, so they can make big money. But when they lose it, the loss is tremendous. So that's why leverage is a very important key concept. And now new financial regulation try to regulate the leverage levels. So that means the say leverage point of say 30 or 40. That means no investment banks or company cannot make leverage more than beyond this level. So that means their losses or profit will be in a sense constrained. So we use the concept of leverage for that situation. So in this case, debt to equity leverage 0.6. That means this company is only collecting, say, fund, which is less than their equities. Okay, leverage 1. It's very, very safe management, right? Safe management. Okay. Okay, so in this way, now we covered all concepts, and now you learn these simulations again. Then you bring all ratio analysis to this diagram. Okay. So this is not a fancy diagram because the transaction is very irregular. But you do get some sense of management analysis or strategic analysis. So as a matter of fact, all strategic analysis is based on this balance sheet. If you remember balance sheet, we have conceptualized balance sheet. Then we do get all current asset, current liability, all concepts, right? Then we try to calculate ratios. So actually, up to this point, it's not so creative. We are using the past historical data to analyze the company. Right? But we can tell something. So the good thing to do modeling is that once we created this ratio analysis, okay, go to this analysis. The question is, where's ROE? Okay. Unfortunately, there's no ROE table here. Okay, let's go back to. Okay. Okay, yes, up here. All right. Just ROE, for instance, take ROE or this one, then diagram. So this is just past data, so it's not so interesting to just look at past. But the question is, in this case, now the ROE is just around this one. The question is, if we want to raise ROE in the future, what will be the strategy? So that's a way we are able to use this modeling as a very powerful tools. So from here, it's a historical data, but we just put one reference diagram to show this is a way we want to increase ROE, for instance, ROE. So what will be the strategy? So this is the way we are going to use the system dynamics model. So, and this is a way we can compete against other the consultants who are not familiar with this strategic modeling. So there are a lot of the advantage of using this system dynamics model because we can cover what they are doing and we can add more. Right. So ideally, I like to encourage since you are not in business school, but you are close to business school, so you try this one. And you can sell these skills as your selling point of your study in Japan. All right. So one more thing I just forgot to cover is this is the inventory process. Bensim is also good modeling tools to cover all production processes, where our production process consists of 10 different processes of intermediaries. Still, then we can model the all processes. Actually, Bensim has a lot of functions, more than 100 functions, which are powerful enough to cover all production processes. But this is a simple production process. So in this model, there is a part of the actual apple seed soft drink production. So we have to cover this production process. So in that case, we just figure out real physical productions. This is the real production process, this working process, and this finished good and shipment. This is a physical term. But accounting system don't include only physical term. We have to convert this physical unit into the cash unit. So here, this physical production process goes along with this value process. It's called a kind of co-flows. Physical production flows along the values flows. Okay. So this is the one technique you can just learn from here. So whenever raw material is used up, then for physical, that's okay. Okay, in this way. So this one, another technique. So in this way, I think I just covered the basic framework of this software, and this is another marketing part, which is not so in detail in that book. And by the way, I found that there are some errors in the book because that book is not so precise. I think at the end of the book, the authors are so tired, so they never check that. So when I put data, I found some errors, but I didn't report to the editor. So anyhow, okay. So far, this is all about models. And finally, that's not enough to entertain your managers. So you have to show all simulation results in the tables, which can be understood by your boss or manager. So this is how you create income statement and cash flow statement. So it's so easy done. So you just create multiple variable tables, which I think you learned from Professor Minato. So basically can create this table. And so this is the way the manager understands. Okay. Right. So we can present in a traditional way, or we can present in the graphical way, and we can show the all individual data available. So this is another way to use this Bensim. I believe this can compete against all accounting softwares. What's the accounting software? Created in German. Many Japanese companies using accounting software. SAP, not SAP. More applied, not SAP. Like people's software. Not SAP. Many companies are using that software for day-to-day accounting.
Yes, some of the popular accounting softwares are FAT and Tally.
Huh?
We use FAT. I don't know about that. I'm some of them use the customized as well.
Okay.
Like
That software couldn't do this kind of ratio or strategy analysis. So when they introduce the software, not very sim, power sim was just attached as a part of their software. That means this part have to be done by power sim. Day-to-day documentation have to, or the record have to be done by the software. That part start. So that's anyhow. That means system dynamics is the most powerful way to analyze strategic analysis of all corporations. That means this software is still useful and demanded for the strategies part of the analysis. So whatever software is available, still this system dynamics software is the essential part. But I was told that the PowerSim was packaged as a part of the software, but PowerSim has never been used among Japanese companies. I think 80% of top 100 Japanese companies are using that software. But the software vendor told me that no company uses system dynamics. And I asked why. They said because there is no teacher, no instructor to use it. No.
It's difficult to make end users understand all these things.
So that's why there are a lot of niche market for you to sell as a specialist of system dynamics model.
Senior executives can understand all these things, but not all the lower level staff.
Okay. If I have time, I didn't clear, but if I'm successful, I can show you the Toyota case for this one. I should have prepared about that. Let's try. Okay. Corporate models, Toyota cables. Okay, let's see. I'm not sure. Okay, that's run well. Okay, graph has to be converted. Sometimes graph okay, it's better to use this one. Okay, go to. Corporate Toyota. Let's try Toyota. Okay, let's try whether this really works. Okay. I think something's wrong with this. I should have prepared this one. But anyhow, this is all balance sheet of Toyotas, all balance sheet of Toyota. This is debit side, credit side, all in Japanese. And from here, the idea is the same. We just conceptualize all assets into current asset and inventory asset and other asset. So liability are put in current liability and long-term liability. So idea is the same. Then we did all ratio analysis, Okay. All ratio analysis. And in this model, I bring all data from the Toyota's Excel. Not this one. Okay, Orion model. This is all Excel data. So you can easily collect all data under the Excel data, and you can read all this one into model directory. Then you do all ratio analysis, and I said this is a complete ratio analysis. That means I checked all books and I brought all definition of ratio analysis. That's the most comprehensive ratio analysis. So I did this one for Toyotas. Unfortunately, I need some readjustment. I haven't used this one, but if you're interested in this is available free, so I can send it to Minato-san. So this is the application of how you are going to use system dynamics to analyze the already available historical accounting data. Okay. And I really like to just bring the same idea into your the model you are working, and actually do some basic ratio analysis of your models, basic analysis. Okay. So your the model looks really like a professional model. And I hope the usually students who study the system dynamics at MIT usually try to present their master's thesis or some models at the system dynamics conference. So I encourage you to create your model and submit it to your system dynamics conference. We really need a young student. So, fortunately, we are going to host Asian Pacific System Dynamics Conference in the end of February. He has more information. And Professor and Nakajima-san are going to present system dynamics model. So you are encouraged to attend the conference. And on the third day, Monday, I'm going to have my own workshop on macroeconomics. If you have time, it's free. You are welcome to attend my workshop on macroeconomics. And I'm going to cover the whole macroeconomics books. Why it's so powerful to use system dynamics, and why it's we can come up with a very good solution to overcome the debt crisis. Actually, I'm going to suggest the better way of overcoming debt crisis. And tomorrow I'm going to meet one congressperson, whether they are interested in the new solutions based on macroeconomic model. So actually, there are a lot of applications, and you are the young generation. I really like you to continue your interest in this area and be the expert. And it's really, I think, product area. And you have a lot of, I think, opportunities to sell yourself as just expert of this area. And so far, Keio and Doshiya University, only university which can systematically offer the system dynamics course. So you are very lucky to come here. Okay. Any questions? I still have some time, and I do get your Q&A part. And also after that, he said there are very fancy bar at the first floor, so we can get together and have some drinks. Okay.
Okay, for tomorrow, from 1 o'clock, final presentation. So be well prepared, and I hope, unfortunately, Professor Nakano is not coming, because he is going on a business trip to Sendai. I'm only